The consensus on the FOMC has not moved to maybe so many hikes, but we are definitely going to do 3 rate hikes this year, if not 4. And you've been in the camp, a smaller camp that says, you know, 1 this year, I don't care if you do 2, but not much more for the next few years. What do you see that the rest of the FOMC doesn't?
Yeah, I would say the U.S. economy is in a slow growth mode, as it has been for the last 2 years. In 2015, the economy grew just a little under 2%. In 2016, the economy grew, I guess we got the number yesterday, 2.1%. First quarter tracking estimates are now down below 1% at an annual rate for first quarter GDP. This does not sound like a booming economy to me. So you know, it's okay if you want to move, make a 25 basis point move, but we don't think at the St. Louis Fed that you have to have a 200 basis point adjustment in interest rates in this kind of environment. The unemployment rate has come down, but it was 5% in September of 2015. Today it's 4.7%. Hasn't really changed in the last 18 months. And we got the inflation number this morning, and as expected, PC inflation has come up. Some of that's energy prices on the headline, but if you look at something more sensible like the Dallas Fed trim mean PC inflation rate, that's running at about 1.9%. Maybe it'll tick up a little bit based on this report this morning. But it's exactly what the committee was expecting, a slow, gradual rise in PC inflation, net of energy prices, and that's exactly what's been happening. So we really have not seen a lot of movement in the hard data in the last 18 months or so, and so I think it's, you know, it's okay to raise rates a little bit, but I don't think we need a major adjustment at this juncture in order to stay on track and keep inflation near target.
Well, you said just a week ago that 3 rate hikes this year could be overkill. Why overkill? And what's going to happen? What's the risk?
This is not an environment where the data is screaming at the Fed that you have to move. It's not like inflation's threatening 3% or you know, the unemployment rate is moving meaningfully. Like I just said, it's hardly moved in the last 18 months. So I think you can wait and see in this environment and see how things develop. And that's been the basis of the St. Louis Fed projection going forward.
So what about you said that the Fed doesn't need to be preemptive. The Fed raised the key rate once in 2015, once in 2016, and now it's talking about 3 rate hikes. That will be 5 interest rate increases in 3 years after a long period with none. Your colleagues are arguing this is so gradual. How could you worry about overkill? How could you worry about being preemptive?
It's not overkill now, but if you go forward with a whole lot of rate hikes without the data really perking up more than it has, I would call that into question. Again, you got first quarter GDP here, tracking estimates below 1%.
Well, it's interesting. Okay, so let me pretend I'm one of your colleagues.
Yeah.
They would say, well, you've got.
I mean, we can argue about that, but yeah.
But GDP isn't what we really follow, and GDP lags, and you know, Jim, unemployment is down. The labor market's getting tight.
Unemployment's down 0.3 in the last 18 months.
Well, but you've got inflation now at target, Jim, and if we wait too long, inflation's going to get out of hand. Inflation's
at target, but it's not expected to move very far from target. In fact, the Fed has hit its goals. Inflation is at target, unemployment's low. What do you want, man? We delivered. So why is it that you can keep the policy rate at such a low level when you've already hit your goals? And I think the key to that is that the world safe real interest rate is very low today, and that's a global phenomenon. And that doesn't look like it's turning around anytime soon based on what's going on in Europe and Japan. And so, you know, if you're setting monetary policy, that very low global safe real interest rate is sort of the place where you start, and then you make some adjustments from there. That is a negative number today in around the world. So 1-year Treasury, ex post real return in the U.S., U.K., Germany, Japan, they're all minus 1% on average. So that's why you can keep the policy rate as low as you can, and nothing bad happens. That's why you can keep everything at target in this low policy rate environment.
Eric Rosengren, who I interviewed actually, it's my lucky week. Eric Rosengren on Wednesday, Jim Bullard on Friday. Doesn't get much better than this for someone like me.
You'll be ready for the weekend.
I'm leaving town actually for a couple of days to relax. But, Eric gave a speech where he, I think, set a new bar for the FOMC. Seems to me what Eric is saying, that by saying that his base case is that the Fed should be raising rates 4 times this year at every meeting with a press conference. That would be 3 more. Because because unemployment's low, inflation is rising, you can't wait too long. So it's as if he's saying the burden of proof is no longer on the economic data to prove that the Fed should raise rates. No, the burden of proof is on the data to show the Fed that it should not raise rates. Do you agree with that view?
No, I don't agree with it. It's got to be more data dependent than that. You've got to be thinking about how is the economy really developing here. Do you really have a pickup in GDP coming in 2017 or not?
So far, the way to the first quarter is that you don't.
You don't, and okay, well, maybe that'll bounce back in the second quarter. Maybe it's residual seasonality. We faced this problem before, but you kind of want to see that happen before you plow ahead with a lot of rate increases.
Well, this is a point I think you've made before, and some others who follow the Fed, that like many forecasters on Wall Street, the Fed has had forecasts that aren't correct. And at this point, it's a risk to base your moves on your forecast and being preemptive or proactive, I should say, rather than waiting for the data to show you that's what's happening and being reactive. Is that where you're coming from?
Yeah, I'm sorry, say that again?
Well, in other words, you're saying better to be reactive, wait to see what the data actually show you, rather than being proactive because you're so sure you're moving in a certain direction.
In this environment with this tame inflation and slow growth and labor markets kind of flat, at least based on the unemployment rate over the last 18 months, I don't think that calls for preemptiveness on the part of the Fed. If we felt like inflation was creeping up and it might get away from us, okay, that's an environment where you say, well, I might want to get ahead of that process and might want to raise rates. But we're not really in that environment. And the data is not very different from what it's been in 2015 and 2016. So if you wanted to make these kinds of arguments, and I did make them at that time, then you should have been making the same argument at that time. But that isn't the world that we're in today, and that's why we switched our view at the St. Louis Fed and said, well, we can keep rates pretty low and still hit our employment goals and our inflation goals.
So let's take a look at the balance sheet. The Fed's what's $4 trillion plus balance sheet, and there's been a number of comments from Fed speakers, especially in the last couple of months, about looking at starting to shrink it this year. Where are you in this process? How are you in favor now of getting going? It seemed to me, again, a week ago, you said that you are.
Yeah, I think we should get going on balance sheet normalization. Before the crisis, the balance sheet was $800 billion. Today, it's $4.5 trillion with a T. We like to talk big numbers at the Fed, so it's way bigger than it was before the crisis got going. I think it's time to end the reinvestment policy, allow the balance sheet to run off. And then as that process is going on, the committee can make more decisions about where they want the balance sheet to be long run. But I don't think anybody wants it to be $4.5 trillion or really even intended for it to be this high. And I think we get back to normal there. Now, one thing about talking to me is I don't think we have a lot of work to do on rates, and so I think the natural next thing to do is to normalize the balance sheet. Another thing I've been concerned about the balance sheet is that when you're raising the policy rate, you're raising a short-term interest rate, and that's supposed to work by raising all interest rates across the yield curve. but then our big balance sheet is putting downward pressure on the middle and longer end of the yield curve. Why are we doing that? That's twisting the yield curve. That's undoing what we're trying to do with the policy rate increases. So I think the more natural thing to do would be to allow the entire yield curve to adjust, all else equal. Of course, as you learned in your classes, all else equal, we're going to allow the whole yield curve to adjust in response to the policy rate increases and not continue to put as much downward pressure on middle and long end of the yield curve.
How would you like to go about it? I mean, so would you start by you talk just rolling on, not reinvesting the proceeds? Do you start at some point actually selling some bonds?
Yeah, I don't think we're going to. I don't think we're going to sell. So I think the question on the table is really just ending the reinvestment policy. What happens now is if something in a portfolio matures, we replace it, and we could just end that policy, and that would let things naturally roll off the balance sheet. There is, if you looked at charts of this, that would mean that it would roll off a little bit unevenly because some things mature some months and some things mature in other months. But we could manage that process. I'm agnostic about that. I think the more important move to make is to allow the runoff to occur.
You don't think there should, you'd be happy if there was no more rate hikes this year, potentially?
Potentially. I wouldn't fight against another rate hike, but potentially. I think it's more important to think about what are we trying to do over the next 2 or 3 years. And we've got a very flat outlook, and the idea is the rate is about where it needs to be today to keep inflation near target and keep unemployment low, and then we'll react to things as they come along. I'm not saying we're not going to react. We are, but we're going to have to wait and see when the next big shock occurs, and then we'll see where we need to go from there. But I do not think that you need to have this 200 or more basis point adjustment just in order to maintain where we are in terms of inflation and unemployment.
If you're okay with maybe no more rate hikes, not reinvesting the proceeds, is that a slight form of tightening that helps do some of the job that your fellow colleagues want to do in terms of tightening up a bit?
Well, it would, because it would allow the longer rates to go up somewhat more than they otherwise would, holding everything else constant. And so in that sense, I think it would be some normalization. But you would want that normalization because that's how monetary policy is normally supposed to work when you're raising the policy rate. What
do you say to people, and this seems to me another part of kind of the boilerplate statement for Fed officials who are in favor of at least 3 rate hikes this year. Sustained growth needs rate hikes. To sustain growth, we must keep this on track and not let it go out of hand. Why is that wrong?
2015 GDP Q4 1.9%. 2016 GDP growth 2.1%. First quarter GDP growth tracking estimate 0.8%. Where's the boom? I don't see it in GDP growth. Now, you could say there's a boom coming because fiscal policy is going to change. And I think that's an interesting question, but what I've said about that is we can wait and see what actually develops. There you've got 2 questions. What is actually going to be able to be passed through the Congress, and what would the details of that be? And then even if it is passed and it goes through with flying colors, how much impact is that really going to have on U.S. growth over, let's say, 2018-2019 timeframe, which is the kind of timeframe that you talk about for monetary policy? And I think those are very interesting questions. There's a lot going on in Washington, but from a monetary policy perspective, we can wait and see what actually happens. It could be that not too much happens, could be that a lot happens. We'll see, and then we can afford to adjust at that point.
There could be a lot of personnel changes next year at the Fed. Janet Yellen's term is up.
I hope I'm on, but
yeah. Well, I think because you're a Fed Bank president, you're probably get to continue your job. But Janet Yellen, well, if I have to vote, you get to keep the job. Stan Fisher, the vice chair, and Bill Dudley is going to be his term's up at the end of 2018. So there's going to be a lot of potentially change. Is it possible that there is a sense within the FOMC that maybe it's good to get this policy of normalization, higher rates, bringing down the balance sheet, well in train before a new administration has a chance to change the makeup, change the thinking, change the direction of the Federal Reserve in a way that would be counter to all the things that this FOMC has tried to achieve for so long, which is the dual mandate, price stability, low unemployment?
Yeah, I mean, I wouldn't try to race to do one thing or another on policy before new people come in. I think you want to have a lot of continuity in policy, and I think we will have a lot of continuity in policy. And here's what I mean. The FOMC is a big committee. There are right now 17 people around the table. So even if you swap out some people and get new faces, you do have a lot of institutional memory, a lot of that coming from the presidents like me. And you have an excellent staff, which is large and very technically competent. And so through that process, I think you can change the direction of policy, but it changes slowly over time. And everything's been argued out in a lot of detail, and so new people can come in, they can contribute to the debate, but they're one voice among 17.
I want to hop to another couple topics really quickly here, and one is the bond market. The U.S. 10-year Treasury was up just over 2.6% on March 14th, the day before the Fed raised that rate and put out the median, the stronger median consensus for 3 hikes this year. It's down to about 2.4. What's the bond market telling the Fed?
Yeah, I think again the yield curve is flattened a little bit if you compare Fed funds to the Treasury, 10-year Treasury. Usually, when you're raising the policy rate, you'd expect the longer-term rates to move in tandem. It's going the opposite way here, and that gives me a little bit of pause about not so much about the March rate hike by itself, but this projection out of 200 basis points or more to come. I think, like I say, that would be too much in this, given the data that we have in hand today.
Potential GDP seems to be another theme that is driving some Fed officials to be on board with a series of rate hikes. And over time, the FOMC's SEP projections, their summary of economic projections, says the long-term equilibrium funds rate has come down, and the idea of the growth potential, the potential GDP rate seems to have lowered, from 2.45% in early 2012 to about 1.9. And I believe it was John Williams said he thinks the potential GDP is now down to 1.6%. Which, if you believe that potential is, quote unquote, only 1.6%, that would seem to be arguing, yeah, we've got to not only hike rates, but if it's growing 2% the economy, you've got to slow it down. Is that the logic, and is that partly what's driving, do you think, the group that is more on board with 3 or even 4 rate hikes?
So that's a story that even 8 years after the crisis, there's still cyclical dynamics going on, and that even though growth is slow, it's actually above trend growth, and it's that's going to lead to more inflation. I think these numbers are all way too small to have that kind of an effect on inflation, and the estimates of where potential growth would be are way too uncertain. The uncertainty bands around those are very large. And if you look at other estimates, they're closer to 2% anyway. So I think it's better to interpret the data as we're basically growing at trend. There are no more cyclical dynamics. Inflation has come back to target. So you've kind of converged to steady state, and you don't really expect anything to happen until the new shock occurs, whatever that is that lies out there in our future. So this idea that there's still cyclical dynamics going on 8 years later, I just don't think that that's consistent with how we think about macroeconomics and business cycles.